all yours.
All right, you can hear me, right?
Yep.
Okay, perfecto. Okay, all right. So we were going to talk a little bit about different types of options and when you would use them. I can do some of this kind of real time in like a PowerPoint doc or something if that's helpful for everybody, but I wanted this to be somewhat of an interactive session, right? So I'm not doing this as a course, I'm doing this for you guys that may have questions on how to do things like the poor man covered call or call debit spread, diagonals, and whatever else. So we can talk about options at any level you all want to. We can go basic, we can go advanced, but do want you all to talk and interact with me versus me just talking at you. Does that work for everybody? Don't ever answer at once.
Hey, sounds good. Thank you, James.
Sounds good.
All right. All right. So maybe option 101. Do you all understand fundamentally how options are priced? Or what influences the price of options? Do you all understand that fundamentally?
Hey, let's just assume that we don't. Just give us a real 101.
All right. Let me pull up PowerPoint, and then we will do it. We will do it from there. All right. Let's see. All right, I have to grant access and system settings again. Sorry, I've not really shared on Telegram before. The hell? But you all can see this, right?
No.
Nothing on the screen now.
Okay, hold on. That's really weird. I had allowed Telegram to share my screen, and then I was trying to share PowerPoint at the same time, but it won't let me go back and share the chart again. That's annoying. Okay, we can do it. We can just talk about it if I can get this to work again. All right, I'm going to drop and come right back, okay? Okay, I'm back. Let's try again. Okay, this is only letting me share TradingView for some reason. I'm trying to get it to share PowerPoint, but it's not working nicely. So we will do our best to do this in here. All right, so fundamentally, the way I two things. One is intrinsic value, and that is the value of the underlying. Example would be Tesla at $400. We buy a 390 option that would have a 390 call option. That would be $10 in intrinsic value. Do you all understand what I mean by that? Yes?
Yes.
Okay. Number two is extrinsic value, and this is what we call premium. And that's pricing that is intended to reflect the potential movements, right, or risk of a security. All right, everybody I think understands those two things. Intrinsic value is obvious, and that is influenced solely by value of the underlying. Extrinsic is influenced by what we know as the Greeks. So you all have heard the term delta, right? You all have heard the term theta, I believe. Yes.
Yep.
And then there's gamma. There's other ones like rho and all that, and vega, but I'm not going to bother with those because those are volatility, right? So delta is movement of the option against a move in the underlying. All right, I'll make that bigger. And I'll come back to each of these. Theta is time decay of the option. And then gamma is the rate of change of delta relative to a move in the underlying. I know that is super confusing and it's annoying. Okay, so talking about delta, this is typically reflected as a number between 0 and 1. If the number is 1, it means that the option is moving fully in sync with the underlying security, right? So between 0 and 1, 1 means like no explosive movement. That means it's just moving with the underlying, right? When you buy an at the money option, this typically tends to be what's called like a delta 70, which means that the option will move at 0.70%, right, of the underlying, right? Theta is obvious, and that's typically reflected as like percentage per day, right? Theta accelerates the closer you get to expiration, right? So in simple terms, time value. And then gamma is how fast the delta changes based on move in the underlying. So example of this would be option starts at delta 20, price goes up, delta will change to a higher number, right? Like delta 50, right? Based on change in the underlying. Why these all matter is these matter because when you are buying an option, especially if it is nearer dated, you have to think about these factors for your likelihood of profitability. A really good example of where premium is inflated will tend to be around earnings events, right? And so that is essentially the expected move, and the options are priced against these factors relative to the expected move. Okay, I have monologued a bit. Is this all tracking with you all? Are you all fluent in these things?
Yep.
Okay. So I can delete that. I think Randy's recording it, so I'll just delete this. But when you are looking at buying spread options, in simple terms, the most basic use case would be you buying an option around earnings. So let's look at our friend Meta, right? So if you were buying Meta at earnings, the premium here would have been incredibly high because of the expected volatility or the expected underlying movement. So if you were buying a 700 call option, I'd have to look this up. One of you can. If you were buying a 700 call option, it was probably something like $10 in premium, right? So it would have been purely extrinsic value, right? So we'll just call this a hypothetical, right? For Meta earnings last week, out of the money, OTM, which is what Randy buys almost exclusively, OTM options are purely priced on extrinsic value, right? Everyone gets that. There's no intrinsic value on an out of the money option. Value is inflated, right? Because of implied volatility. Therefore, to make money at expiration, the underlying must increase above the strike and the premium. So example, Jan 31 700C was trading for $10 on, what day was earnings? Wednesday? On to make profit at expiration, we would need Meta to trade 710 or higher. All right, everybody understands these basics, right?
Yes.
Okay, so if you are planning to trade earnings and you're planning to buy long call options, that is inherently low probability. So you all have heard about vol crush, right? I almost wrote curse, but that's true. Equals collapse in premium because uncertainty is removed. So when you have an earnings event, immediately after earnings is released and whatever move happens, you have removed all of the uncertainty, right? So this is your extrinsic value, right? Option returns to intrinsic value, right? Theta accelerates, then like vega diminishes, right? So if you're going to trade earnings, for example, and you're going to make a binary bet on the stock going up, would you do it through buying call options, naked long call options without upper side protection, or would you do a different strategy? Different strategy, right? So this should be captured on video, so I will erase this. All right. Now, if you're going to trade earnings on Meta, what's a smarter way, right? You could do it through shares, right? You could try long call. Risky and low probability, right? You could sell puts, right? You could trade spreads, right? So the risk with selling puts is you need 70K, right, to do it in free available capital, right? High risk, and then you have risk of assignment. I know earnings have inflated stocks lately, but some of you all may remember that Netflix went down by, I think, 70% of its value after earnings about 2 years ago. It has since 10x since that point. But if you were a short put seller without protection on that day, and you were viewing it as an earnings trade, you had a hard time with that. All right, and then there are other exotic products, right? And so you can trade spreads. So within spreads, there's the call credit spread. There is the put credit spread. There is the call debit spread, and the put debit spread. Then you can also trade the exotics, right? And so this would be your iron butterfly, your iron condor, your, I wouldn't do a diagonal for earnings, but your calendar, strangles. I guess I could put strangle and straddle somewhere else, right? That's a permutation on long call or long put, right? You can also short. This could be long or short. Okay, so for an earnings trade, you can pick any of these options. And so now I'll go through some of the potential options. And I think earnings is a good scenario for talking about these. If I can get this thing to move up, hold on. It's not cooperating with me. Sorry. All right, there we go. Okay, now, if you want to trade earnings as a binary event, and let's say your thought process is the stock is going to be flat or higher, right? What would you do? You would probably do a put credit spread. And a put credit spread is a short, higher cost strike and a long, lower cost strike. Does everybody understand how this would work?
No.
Okay. Let me move this. I'll do it over here. All right. So if you were going to do a put credit spread, you would do I'm just going to do it down here. Like, let's say we're doing it on this candle. Sorry, wrong thing. You would do an upper strike, and that would be a short strike. All right, so this is short, upper strike. And then you would do a secondary strike that would be a long underlying strike. All right, and so this is actually the key point to understand on how this works. So now we'll try to explain this in a non-confusing way, but once you get it, you get it. So if this were the earnings day, right, the January 14th candle, and you had a short upper strike and a long underlying strike, what it would mean from an option point of view is that you would have received premium for the higher strike. So we'll call it the 600p, right? And then you would have bought the underlying long put, and we'll call it, for simplicity, the 590. And so the way that would work is because the short strike is at a higher value, the premium by default for it is higher, both because of intrinsic value, but also because of extrinsic value, right? And even if it's out of the money, it would be closer to in the money, no matter which direction that you were. So if you're in the money, it's got a lot of intrinsic value. If you're out of the money, the extrinsic value is higher because it's closer to being in the money. So hypothetically, short strike would be $10 in premium. Long strike would be $5 in cost, right? So net $5 premium, meaning that if Meta trades above 590 at expiration, you keep $5 in premium, right? All right, this is actually the key point for this, right? If it closes below, sorry, wrong thing. If it trades above 600 at expiration, you keep $5 in premium. If it closes below 590, you have lost $5. And so that's the risk of the spread, right? And then if it's between, it is the difference between the two. So if it closed at 592, for example, you would have lost $3 on the trade. Okay. Do you all understand what I just tried to explain?
Yeah, James,
So-
I understood the explanation. Never have done that in practice, so it's still just kind of fuzzy in my head how it would work.
Okay, so let me try this. This takes a bit to get. So the risk to you is essentially the risk of the spread. So if you're buying, this is a short option. So this is a premium collection option, right? So if you were shorting the stock, right, or wanted to short the stock, you would buy the 600 put, and that would have a premium. And then wherever it closed, right, you would either make money or lose money. When you sell an option against it, selling that option against it reduces your cost, but it also creates a fixed risk and a fixed profit scenario, right? So these are, try to move this. So it's a fixed risk, fixed profit scenario. And the reason why that's the case is that your maximum risk on the trade is your spread risk. So you all, I think, are familiar with how covered calls work, right? Covered calls are actually similar to this, where you're collecting premium, but your upside in the stock is capped. All right, I'm going to leave this, but I'm going to try to make this smaller. Okay, there we go. All right, you all understand how covered calls work, I presume, right?
Yes. But so before you go to that part, going back to what we actually did to enter this, we are buying a put and we're selling the put. And that's, I mean, the spread there is the risk. I got that. So what is the risk of assignment of this of shares?
You have risk of assignment if you don't close the option. Great question, by the way. If you don't close the option and it closes in between the two strikes. So if you were short the 600 put and it closed at 592, if you didn't close the option, you have risk of assignment. But in almost all cases, you would close the option. And if you closed it like at 255 on the Friday of expiration, the premium for the long strike that you bought, right, essentially goes to zero. And then you would have to buy to close the short option that you had.
Okay. So
that gets into spread risk. I can do a hypothetical on that if it's
But no, that actually makes sense. I'm understanding what you're saying. So what I'm trying to think of though, is as long as I have this trade open, I've got to have the available funds to cover assignment in the event, even though I'm going to close this out before I get them assigned, right? But I still have to have my funds are going to be tied up, or I have to have those funds available to be able to buy the shares in the event they were assigned. Even though I'm not going to let them get assigned, I'm still going to have it tied up, right?
From a trading perspective, no. So the way that brokers think about that is your max risk would be the risk of the spread, and so they will not consume your margin, right? And if you did not have the available money in your trading account, the broker would automatically close your option ahead of expiration. So I think some of you have experienced that in here, where you've had options that have been auto closed for you at like 2:45 p.m. instead of at 3 p.m. And the reason why that has happened has been because of assignment risk.
Okay.
So like hypothetically, you did 200 put credit spreads with NVIDIA, right? Actually, let me pick a higher value option. You did 500 put credit spreads with MicroStrategy, right? $400 stock. Not a lot of people are going to have, $800K in their trading account to take assignment on that many shares, right? But if you are doing good account management discipline, you would want to have closed the trade way before expiration. Now, if you're in that 600, 590 and Meta is trading at $610, right, at close, just let it expire. And if you do that, you get max gain. But I would argue that when you're down to pennies, the smarter thing to do is recognize that you're going to get like 2 cents more, but you have to take on, 15 minutes of risk, and you can just mentally put it behind you and move on. But, like Randy is a guy that will wait for every penny. I am not a guy that will wait for every penny. Like Randy will wait until his covered calls close at 0 versus closing them for 5 cents, right? I'm more of the type that if I've gotten 90 or 95% of the premium value, that's good enough for me. Randy, I hope you're listening to me smack talking you. All right, does that make sense? Good question now.
Yeah, it makes real good sense. And I've noticed that I've had options that get closed out at 2:45 or 3:45 Eastern, and I did not realize that I didn't realize I didn't have an explanation. You just explained a lot to me right there. So thank
awesome. Then our friend Manuel asked a great question. And you cannot trade a put credit spread in a cash account. You have to have a margin account to trade put credit spreads, call debit spreads, or any type of iron condor. You can do long calls, long puts, short puts, and covered calls, but you can't do it with protection, essentially. So a good way of thinking about this would be put credit spread is a short put with protection. And so you can trade these, by the way, on any time horizon, right? So if we were going to trade intraday, for example, on our favorite product, and I'll give a hypothetical trade on this, and I did not take this trade because I was not paying attention to it, but if on Friday you saw the S&P have a 10-minute close below the opening range, that is a really good indicator that the market is going to be going down, right? And what you could have done here is you could have sold a call credit spread, which is the opposite of a put credit spread, or you could have entered short and hoped that you would, make money on it. This was an extreme move, and you would have made money, right, pretty much regardless of what you did. as long as you were short and not long and buying the dip like a dummy. But if you were doing a call credit spread, what you could hypothetically have done would have been buy a strike around, sell a strike around here, and then buy a strike around here. I can get that to click. All right, let me do text. All right, so this would be your short call strike. And then this would be your long call strike. And so this is also a premium move, right? And because the short call strike is deeper in the money, right? Higher premium, right? And because the long call strike is further out of the money, it is lower premium. And so then for the call credit spread, it's betting on flat to down, and you are pocketing premium with the expectation that price, oh my God. All right, I need to ring that in. You're pocketing premium with the expectation that price remains flat to down. So if you saw this single candle and you sold a 6091 call at, or a 6090 call at 12:30, and you bought a 6100 call, you probably would have gotten, I'm going to guess, about $5 in premium on the $10 spread, as long as the price doesn't close above 60.90, you make max profit. The thing that's really forgiving about the spreads is that you will make money even if you're in the intermediate line, right? So if you had an even priced option, right? So hypothetically, we have an option that is a $10 spread and neutral priced. So that's 5 in premium, 5 in risk. As long as price closes below 60.95 on a 60.90, 6100 call credit spread, we make money. And so what's nice about these strategies is that you don't have to worry about theta decay. Theta decay works in your favor, right? So you want theta decay, but you don't have to worry about IV crush. You don't have to worry about premium collapse. You don't even have to worry about being materially right. So if you bought a 60-80 lotto, you have to get real movement to get the 60-80 lotto. If you do this strategy, you don't have to do anything, but wait. But in fact, you can have 5 points of risk against your position before you get to the unprofitable point, and then you have 10 points of risk for max loss. So if price closed at 60.96, you lost $1, right? If price closed at 60.94, you made $1. And so I love situations where, and I do these intraday all the time. I do them with put credit spreads primarily. And the reason why I do it is I expect that the price is going to go up or remain flat. I don't want to have to worry about chasing something with a lot of premium, especially on a big day like FOMC. And so all you have to do is set it, forget it, and wait. Okay. And Randy, you are right. It does take the best to get all of the premium. You're better than me. Do you all understand the basic premise of the call credit spread?
Yeah, it makes sense. I got it.
Okay. All right. The opposite of this, and I'm just going to delete these. The opposite of this is the call debit spread or the put debit spread. Let's do the put debit spread while we're here and it's easy, right? So I did not want that color. All right, so you see the same setup this morning. You see the bearish setup, right, of price breaking below the opening range. When price breaks below the opening range, especially when there's a gap, there's like 99.999% odds it's going to fill the gap, by the way, for future reference. But let's say you saw this setup and you wanted to get short. What you could have done, instead of buying inexpensive out-of-the-money options, is you could have bought to open a 60-90 put, and then you could have sold to open a, let's just say, 60-75. And the way that pricing would work is you pay the option cost on the long put, which is the 60-90, right, minus premium received on the short put, which would be 60-75. And so we'll hypothetically say that the 60-90 put costs, I'm trying to think of something that's attractive. The 60-90 put costs $10. The 60-75 put returned $4. Net option cost equals $6. So in this scenario, let me move this line out of the way. All right, so in this area, in this scenario, your max profit, this is important, is capped at $15 minus premium. So $11 is your max profit, right? Max risk is $6. So that's nearly a 1 to 2 risk to reward ratio, right? And so in this case, where we had the $6 premium, find 60-84 or 60. All right, right around here, and I'll put this as a red line. This is the point that price has to close below in order for you to make money. So your risk, right, is the $6 here. Your max gain or your profit potential is the $11 or the don't tell anybody I screwed up my math on this. It's Saturday. I get a break, right? All right, so your max profit is actually, sorry for my screw up on that, I'm going fast. Your max profit is actually $9, right? So that's 1.5 to 1 on risk to reward, which is really good. Now, if price goes all the way down here, you're still capped at $9, but your likelihood of succeeding was much greater. Trend moves like this are much less common. The other benefit of this is that you have theta decay working in your favor. So meaning that your long option is going to decay, right, just as it normally would, right, relative to expiration coming at the end of the day. But your short option is also going to decay. And if your short option is further out of the money, it will decay faster than your option that is long in the money. And so it's easier to be in like a 0-day or a 1-day trade if you do this, because it's going to last, you're able to last longer in the trade without worrying about liquidity grabs, getting dumped out really early. And if you're wrong, the option is frankly more forgiving for you to get out of it. So when you're trying to get out of the option, like let's say price up here when it went against us and closed above this number, we are going to get benefit from the premium on this lower that was further out of the money collapsing at a greater rate than the premium on the long option. And so we're going to be able to get out gracefully with a smaller loss. So spread trading, in my opinion, is essential if you want to be a intraday day trader. And this works on every security, every option, everything else. Okay, you guys get the basics of this? If you don't, please tell me. I'm doing this for you, not for me.
Yeah, it's good stuff, James. Thank you.
Well, I'm still trying to understand the difference between the two scenarios there. In other words, what is the difference here on the put debit versus the put credit? I just got lost there.
All right, so put credit spread, the play is collecting premium, right? Mm-hmm. So you essentially had a short strategy, a short option strategy, and your max profit is through premium collection. Okay. On a put debit spread, you need to have intrinsic value, right? So so price has to be below, right, the spread difference. So the put debit spread would be essentially taking a long put strategy, but then you're capping your gains by having a strike that is further out of the money. And the reason why you're capping your gains is that you, one, want to reduce the upfront cost of the option, and then two, you're not betting on it having an outsized move. So if you get an outsized move, a long put is, of course, the better option, but you can typically buy 2 to 3 or 3 to 4 put debit spreads for the cost of one long put, right? And so it's a very powerful strategy because of that. And if you're getting into like intraday hedging scenarios, for example, like let's say that the price is still up here, right at the 60-90 area, and you say, you know what, I think this could get really ugly. So I'm going to buy a let's say 60-75, and I'm going to short a 60-65. In this scenario, you probably paid $2 for a 60-75, 60-65 put debit spread. Max gain potential is $8, right? So $10 spread minus premium paid, right? And that's a 1 to 4 risk to reward ratio, right? And you don't have to think about theta. You can just do it and wait. And so this is very good for lotto type strategies, but it's also good for having, frankly, excellent return on investment for intraday options. And so if you're just doing a long put, you have to worry about, you know, this $2 probably would have been 6 or 7, right, at that pricing and that time of day. You would have had to have needed for the pricing to close at 60-69 for you to make money versus price needing to close at 60-73, right, or below. So it's very attractive for risk to reward. Put debit and call debits are really useful for earnings plays as well, right? So if we go back to our Meta example, if we were buying an earnings play and we said we were going to buy a call debit spread, which is the opposite of it, and we were going to set a strike at 676, and then we were going to set it, well, let's just assume that you can do 676 to 686, right? So if you did the $10 spread, in this case, right, for earnings, if you bought just the 675 call option, that probably cost $25. I don't know if anybody has the premium record on hand for Meta earnings, but I bet it was that amount of money. If you bought the 675, 685 call debit spread, it probably cost $5, right? So in this case, you made a binary bet on the underlying moving. Yeah, I have a mechanical keyboard too, big boy. But you're like Nazi Germany with your keyboard. I'm not as severe. All right, so probably would have cost $5, and so Meta would have gapped up in the morning, right? Traded way up here to 710. You could have sold probably for 80 or 90% gain on your option, and you would have crushed it. But if you had bought that 675 call, maybe you would have made money if you timed it perfectly right at the start of the day. But you were dead. And so even if you just held this option through expiration, your risk would have been 20% of your risk of what you would have risked with a straight long call option. And then it was low stress. You knew up front that you had defined risk. You knew exactly what your max profit potential was, and you could have held that through Friday, and you would have gotten max profit. Okay, does this concept make sense?
Yes.
Okay. All right. So this is the value. This is the value of spreads. I'll cover a little bit more because I don't want to take too much of your Saturday, and I think it will take longer for me to explain condors and butterflies because they're just inherently more complicated. But we'll do it sometime next week if you guys are open to it. Probably needs to be evening for me, just with everything I have going on in my fucking crazy life. But this is a fantastic way, right, to do trading. Someone brought up the poor man covered call, and I'm gonna try to chart this in a way that makes sense. But the poor is essentially a longer dated long call offset by a shorter dated short call. And so this is a variation of the call debit spread, but it's a diagonal. And so the reason why this would be a diagonal is, let me do text on this first. So the hypothetical here would be, I'll do the easy one, buying a Meta $800 2026 Leap, right? And then selling a Meta 750 Jan 31 2025 call. And so why that would matter from a math standpoint is, I don't know what the pricing on this is, but I'll make it up. All right, the Leap is probably, let's see, that's like 20% of the money. That's probably like $70 in premium. This is an extreme example, right? The 750C for earnings was probably $2. And your bet there is that the stock will not move that much after earnings, and you will be able to collect the $2 in premium, let it expire, or buy it back for low. and then you get to keep your leap. So this is a diagonal or a poor man's covered call. Does that make sense? The other thing here is that hypothetically, you can keep doing this, right? So you could sell weekly options, right? Or monthly options against your 800 leap, right? Until the cows come home. All right, pausing there. Does this make sense?
Yes.
Okay, so that's the poor man's covered call. The other like simple, quick variation of this is something called the calendar. I'm going to stop after this. We can resume in another session, and I can do any Q&A you all want to do on anything. By the way, I'm not Randy, but I have a different style than he does. But you know, maybe my perspective is helpful. The calendar is longer dated call at X strike. Example 700C on Meta. Offset by shorter dated call of exact same strike, but nearer term. Example 700C on Meta expiring a week earlier. So some of the people who do these, they would see like consolidation or a squeeze. I think it may break out. So a good example of this actually would be a next week option. If you think of one, this would be like buying a Friday SPX 6100. No, 6200C. Selling a Wednesday 6200C. That would be the general expectation of this, right? Of how that would work and how these are harder to do, and these are what funds do, right? I don't personally do this because I think it's crazy and wild and difficult to manage with timing, but your bet is that the price will go up, but it will not reach your level before the short strike expires. And so that's actually a really good way of building like an option portfolio. Like I used to do this on Friday options, where I would buy the Friday long XPX calls and I would sell the Thursday ones and just try to get like some minor gain off of it. But that was earlier in my, I guess, trading journey, and I realized it didn't really work for me, and that the put debit spread is superior to this. But the calendar is something that you will hear about. You'll also hear about the double calendar, which is basically the above, but with calls and puts. So this would be long call, short call, same strike, long put, short put, same strike, but different expirations. Does that make sense? So if you all remember Aggie Daniel from from TexAgs, he is a huge proponent of calendars and diagonals and double diagonals, and so he's a very good trader. Wish he was around a little bit more than he is, but he is somebody who did trades like this. If you all follow Simpler Trading, Bruce Marshall, who is a options income trader, he is a big user of diagonals, double diagonals, and calendars. For the type of trading that Randy and I do, not good and not effective. But if you're trading a fund or you're trading a huge amount of money, it's a very effective way of betting on the way the market's going to go. Okay, that's it for today. What can I answer for you guys? Any topic?
While they're thinking of questions, I just want to thank you, James, for taking the time to do this. And we'll be posting this up, and we'll also get it into the Vimeo archives. So these are excellent strategies. We have a diverse group of traders in here. We have people with very little experience. And then we have some, I know of at least two that are managing over $10 million. One is up to $20 million that they manage in portfolios. So we have some larger traders as well. And they follow many of these same approaches that James has given. I will do a couple of these at optimal times during the year, but other than that, I tend to not use these as much. But they are effective, and they can definitely be added to your tools of how to make money in the market. So, James, something that might be good is not right now, but maybe build a hypothetical for ARM. ARM, right? So ARM is reporting this Friday.
Let's do it now.
We have people that have anywhere from several hundred shares to several thousands of shares. And so they're going to, let's take it from a perspective of they have no shares. What would be the way that they could trade ARM in a way to seek gain with minimal loss? That would be a great case study because people could then turn around and decide, I want to apply this and test the strategy with a potential good gain.
Well, let's just do it. All right. So if we're looking at this from a technical standpoint, ARM has been in a pretty good consolidation base. This has been range bound for a while. Let me shrink this. All right. So if we are going to do a strategy on this, a point of interest for ARM by default is going to be here. All right, this is the magic happening in real time, folks. These are approximate levels, so I'm doing it quick, okay?
Yeah, and we know that 149 is a major pivot. This is the one that earlier this week that or was it last week? It was last week, I believe, that when it pivoted above that 149, we were prepared for that, and we caught that move all the way up into the 180. So we made a huge gainer off of that pivot from 149, just above 149, but right there in that area. That's a long-term pivot. If you back out and look at it from inception, you'll see 149 very critical. All right, sorry, go ahead.
Nope, all good. So I'm marking the major supply and demand points. I'm going to mark a minor one here. Let me use a different color than that. It's not that visible. Okay, I would be really surprised if ARM didn't touch this level at some point between now and earnings announcement, even if it happens during earnings. I have to assume neutral bias on this, Randy. So if I were doing neutral bias, I would probably do a vol crush strategy. right, for earnings. We did not talk about this, but I would do short iron butterfly, most likely. And that is short call at the money, short put at the money, long call, $5 to $10, OTM probably 10, even 20. Long put 5 to 10 to 20, OTM probably 10. Play on this would be collect premium from the short call and short put, minus debit from long call and long put. I'm guessing that this is going to pay in the range of $6 in premium versus $4 in risk is my guess. Option 2 for me, Randy, is I don't want to bet against ARM, right? Because I believe in their product and it's hard to bet against semis. Option 2 for me would be straight up put credit spread. I would probably do 1 at the money, short put, 1 OTM, long put for a 1-to-1 R to R. And then if I were gambling, right, I would do 1 well in the money, short put, 1 ITM at the money, long put for a 1 to 2 risk to reward. That's how I would trade ARM earnings just looking at this. Maybe let me explain why. At whatever price ARM is at after the earnings, it is really highly likely that it will retrace at some point in the following 2 days to the closing price that it had, right? And part of that's vol crush, part of that's people that are buying and selling and profit taking and whatnot. This is generally in a pretty clear uptrend after bottoming in August. Fake breakout here, but I do think that ARM is still going to tend to go up, and semiconductors lately after earnings have tended to exceed a higher number. If I were going to do a earnings share buy, which I do sometimes, what I would do for that is I would try to get that around, let me pick a distinct color for this. I would try to do that around this yellow line. So that's -1 ATR. That's about 15% away from the current price. I would just put something out there post earnings and see if it fills on a flash, and then dump it on a retrace for an easy 4 or 5% gain. Randy, all that said, I may not trade this. I'd have to see how it acts Monday and Tuesday before the earnings.
Exactly.
Let me look at weekly time horizon on this, actually. Oh my God, this is annoying. Hold on. That's bullish. I mean, your risk is to here, right? Your risk is to 125, right? If we're looking at weekly, right?
Yeah, it'd take a big miss to drop below 125.
Yeah, I think the 140 buy is smart. Yeah, I don't know. I tend to stay away, but the other reason why I do some of these earning strategies is, if you're risking like $2 or you're risking, $400 out of, I don't know, $100,000 account or whatever, that's not so bad for the binary gain, but it's hard to tell what happens. And, you all should know this, and the seasoned traders know this, but earnings events are completely binary, and factors beyond the company stock, people dig into things people say, they're really binary. And so trading short-term options around earnings, I just view as being stupid. And, if you're gambling and you have a strategy and you're, doing it small, like, okay, right. But, these guys who are going to devote 20% of their account, right, to an earnings trade, like, they're just lunatics.
Appreciate it.
All right. Quite crowded. Anything else I can answer? Any topic? Seriously. Okay. All right. Well, sorry for boring you.
I think they're all paralyzed from the fire hydrant of information.
This takes a while. This takes a while to get. Don't feel bad if it didn't. If you didn't get it the first time. I don't remember how long it took me to get it, but it definitely wasn't the first time.
No, it's a lot to digest. Thank you for doing this.
No, and remember, I'm here and I'm around. You can IM me, right? I don't always check the thread during the day, but I do try to respond to everybody that messages me.
So James will come in between his real job until I get him to get out. But you're going to sell the company, right? At some point, the company's going to get sold.
Yeah. Yes.
Is that happening right?
Actually, this is. I mean, you get it, right? You're a contact center guy, right?
Yep.
If a lot of your self identity and a lot of your view of yourself is wrapped up in your work and the work that you do, even if you're good at something like trading, it's not easy to walk away from that. Trading can be a solo sport. I love this community because it's a team sport, and it's a lot easier when there's people you can work with, bounce ideas off of, learn from, like Randy. And that's what's great about the OA1 community. But, it's not an easy pivot to switch to being a full-time professional trader.
No, it's not. So, from a contact center standpoint, I mean, I had been trading, and we had been doing a little bit of an overlap in the beta of this. So, but we're never going to be, as I pledged to everyone, we're not going to be marketing for large clients, member base. We lose what's special about what I think the forum offers. If you get to thousands of subscribers, it just becomes monotonous and a mess, and it's very difficult to manage, much less when you're trying to enter and exit cleanly. My experience watching some of these others that, they have several thousand people or thousands, and you call out a trade, and next thing you know, the premium will spike artificially, even though the price of the stock's not moving. They spike the premium because of the number of volume. And what happens is those people are jumping in, and then the guy doing it is selling into the people buying. And, on one hand, you're like, well, if you have a defined discipline to where I'm going to be selling at a certain percent, then do you blame that person? But it gets into that level, right? Well, I don't want to do that. I don't like doing that, right? I don't want to be part of that. And so I think it's better if we have just a good community. I said that 300 I thought was like a prime number, and we haven't marketed. We're now target marketing. So some of these people that you guys are seeing coming in, are target marketing. In other words, they're people that I've seen. They message me, and so I know at least cursory information about them. But I will say that I will manage it. In other words, if we have people, just like when we first started, we had some people that I invited out. And because we're trying to do something here special, right? We're trying to create wealth, and we're trying to create a chemistry. One of the things that I've been personally asking some people, James posts some of his trades on here. He'll tell you when he's buying, but just like I do, before he buys, he'll tell you, if it gets to this point, I'm buying this. Well, that carries a lot of weight to me. So generally, I follow the trade when he makes that statement. I will generally get in the trade. I'll look at the chart, but generally I'll get into the trade with him. Well, we have other members that are very good traders. So I've asked them if we could put them in the alert section. So the alert, generally James will post, I'll post. But I would like for these other individuals that have gained trust, and they've met, like Thompson, TNT Aggie there. Friday, he made a call on Apple. Apple was, it had been sold all day long. He bought next Friday calls. They were $1.47. I joined in at $1.47, and within, I think, 10 minutes, I had a $1.90 trim, and I sold 50%. So I go into the weekend after telling everyone I'm going into the weekend flat. I go in because of who it is saying about the trade. I go ahead and take it, and I'm carrying now 50% of a trade into Monday. Even though my edict before the market open Friday was I'm selling into the open. I'm then we could scalp a little bit early, but we're that golden zone, we're most of the way there. And so why would we want to be risking money there? Now, we didn't anticipate the impact of that press conference on the tariffs, but it was also a byproduct of good fortune, right? To be out of the market when that happened. And so we have good traders, and I just want to make sure that we maintain that structure of the community, and that we're educational. As I said, between the first 90 minutes of trading and the last hour is when generally you're going to want to be taking any trades that you have. There are trades within the day if they're longer term setups, but otherwise, if I'm here between 10 o'clock and 2 o'clock, it's only because I am committed to showing patterns in the stock market, showing how institutions work. These are not things that I'm trying to impress people, to make trades. I'm just educating. This is how these stocks are moving and why, and foretelling here. When we see that bear wedge, this is going to break down. Here's the level that it has to break down. If it doesn't break down before that and it gets above, the bear wedge is now invalid. But how many times have we done this when we show that bear wedge that sure enough, right as it enters into the retest, it fails? And so, but those are short form trades, right? They're very short form. So anyway, I just want everyone to realize what we're doing and the direction we're going. I don't want members who have been here that see suddenly, a little jump in membership, thinking that we've opened up the portal to the world. We have not, and we are not going to be going out mass advertising. So we'll be very selective just to keep the continuity of the community. All right, that's it. James, anything else from you?
No, just my final message that I repeat often: know when not to trade.
That's it.
That is the only difference between a profitable and a non-profitable trader is this. That's it. I mean, risk management aside, this is the thing that matters.
Amen.
All right, folks. Thank you. Catch you Monday.
All
Or
right.
tomorrow night at 5 p.m.
Bye.
Bye.
Guys.